When you think of investing success, one name probably pops right into your head: Warren Buffett. But how did one of the richest people on the planet build a massive empire, not with some flashy tech invention, but by just consistently outsmarting the stock market? Well, the secret is a surprisingly simple yet incredibly powerful philosophy that we're going to break down right now.
It all really starts with these two famous rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Sounds simple, right? Almost too simple. But believe it or not, these two sentences are the bedrock of a strategy that has generated just staggering wealth for decades. The real question is, how did he actually pull it off?
And when we say wealth, we are talking about a fortune of over $100 billion. Now here's the wild part. He didn't get there by building rockets or creating a social network. Nope, Buffett just quietly kept winning at the game of business and investment year after year after year.
So that brings us to the big question we're tackling today. How on earth did a shy kid from Omaha, Nebraska, who grew up during the Great Depression, become the Oracle of Omaha, one of the most successful investors in history? Well, the story starts a lot earlier than you might think.
Long before he was a billionaire, Warren Buffett was basically a tiny business tycoon. His knack for making money wasn't something he learned in a fancy business school. It was forged right there in his own neighborhood when he was just a kid.
I mean, just look at this. At age 6, he was going door to door selling Coke for a 5-cent profit per pack. By 14, he was running multiple paper routes, pulling in what would be over $3,000 a month in today's money, as a teenager. And then, just a year later, at 15, he takes his profits and buys a farm. This wasn't just a kid with a hobby. This was a sign of everything to come.
You know, his very first dip into the stock market was a huge learning moment. He's 11 years old, and he buys 3 shares of a company called City Service. The stock drops a little, he gets nervous, but he holds on, and he sells the second he makes a tiny little profit. He probably felt pretty smart for about 5 minutes. Then he watched that same stock shoot up to over $200 a share. Ouch. That painful miss taught him the most valuable lesson of his entire life: patience.
So after high school, he actually got rejected by Harvard, which, funny enough, turned out to be the best thing that ever happened to him. Instead, he ended up at Columbia Business School, and it was there that he met the man who would literally change his life and shape his entire approach to investing.
That man was Benjamin Graham, the father of what we call value investing. Graham's whole philosophy was about ignoring the day-to-day noise and hype of the market. Instead, you do the hard work to figure out what a company is actually worth, and then you buy its stock for way less than that. Buffett just soaked it all up, becoming Graham's star student. But Buffett knew that being a numbers whiz wasn't enough. Get this, he was absolutely terrified of public speaking. I mean, so scared it would make him physically sick. He knew this fear was holding him back, so he forced himself to take a public speaking course. To this day, he says that decision was one of the single best investments he ever made, proving that the most important thing you can ever develop is yourself. Alright, so now he's armed with Graham's theories and this newfound confidence. Buffett goes out and starts his own investment partnership. And he begins by taking his mentor's philosophy to the absolute extreme, with a strategy he gave a pretty colorful name: the cigar butt approach. The idea is just as gross as it sounds. You're walking down the street and you find a nasty, discarded cigar butt. But hey, there's one free puff left in it. In investing, this meant buying absolutely terrible, failing companies that were trading for so cheap that their assets, their desks, their factories, their chairs, were worth more if you just shut the company down and sold everything for parts. That little bit of extra value, that was the free puff. And believe it or not, this wacky strategy worked. I mean, it really worked. He started with about $105,000 from friends and family, and in just 6 years, that partnership rocketed to over $7.2 million. He was absolutely crushing the market averages. The cigar butts were paying off, big time. But as successful as he was, Buffett knew the cigar butt strategy had a ceiling. I mean, there are only so many terrible companies out there to buy, and it's not exactly a way to invest billions of dollars for the long run. This is where his longtime business partner, the legendary Charlie Munger, stepped in and influenced a huge pivot in his thinking. Munger convinced Buffett to completely flip the equation. This shift looks subtle, but it is absolutely profound. Instead of following Graham's way, buying fair companies at wonderful prices, the cigar butts, he started focusing on Munger's way, buying wonderful companies at fair prices. This was a massive change, from pure bargain hunting to investing in high-quality businesses for the long haul.
So what makes a company wonderful? Well, Buffett uses this brilliant term, an economic moat. Think of a medieval castle with a giant moat around it, protecting it from invaders. For a company, that moat could be a super powerful brand, a secret recipe, or a huge cost advantage. Just think about Coca-Cola. Their brand is a massive moat that no competitor can easily cross. That's what Buffett started looking for.
Now, to put this new philosophy to work on a massive scale, Buffett needed a vehicle. He found one in a failing old textile company called Berkshire Hathaway. He took it over and began transforming it into a holding company, a mothership for all of his investments.
But just buying shares in great companies wasn't the whole story. As Berkshire grew, Buffett unlocked a financial engine that would pour rocket fuel on the fire and accelerate his wealth creation like nothing else. So, what was the secret weapon?
The answer is insurance. This was Buffett's secret weapon. He realized that insurance companies were the perfect businesses to own, not just for the profits they made on policies, but for the enormous piles of cash they generated. Okay, here's how it works, because it's pure genius. Step 1. We all pay our insurance premiums, right? Step 2. The insurance company collects all that money into a giant pool of cash, which is known as float. And here's the magic. Step 3. Buffett got to take this massive, ever-growing pile of cash, which was basically an interest-free loan from all the policyholders, and invest it for Berkshire Hathaway's own benefit. So you had this perfect combination, a strategy of investing in wonderful companies with wide moats, fueled by billions and billions of dollars of free money from the insurance float. And the result? It was just unstoppable. Berkshire's stock price went from about $11 in 1965 to over $7,000 by 1990. The machine was working perfectly.
So, what can we all take away from this incredible story? Well, Buffett's journey really boils down to these timeless principles. Think long-term. Be fearful when other people are greedy and greedy when they're fearful. Only invest in businesses you actually understand. Focus on wonderful companies. And maybe most important of all, just never stop learning.
From selling Coke door to door to building a $100 billion empire, Buffett's story is just a masterclass in patience, discipline, and continuous learning. It really leaves us with one final thought to chew on. What is the single most valuable lesson that you can take from the Oracle of Omaha?